Good evening, TheoTrade. This is Corey Rosenblum, and you're watching the Theo Nightly video for the 6th of October here in 2022. We have a big jobs report coming up tomorrow, and that's going to be the focus of tonight's video. Right here. Can't really see it, but it's on the employment situation, labor force survey, and the other economic events that will take place before the market opens on Friday. So let's take a quick look at that to begin our video. The non-farm payrolls, or the monthly jobs report, or the big jobs report, that'll take place 1 hour before the market opens tomorrow, and it could be a catalyst for a big move, or it could be a dud. We don't know, but we'll frame out some of the levels and what the market, especially the expected moves for our big products, are suggesting. But the market, at least in terms of our forecast, that's looking for about 250,000 jobs added to payrolls. And of course, the unemployment rate comes up, but there are other data points, average work week, earnings, and what the other deeper details, if you want to dig a little farther into the report, you can see some of that and how it shapes up for the economy, what the Fed is likely to do. Of course, we're still in that scenario where good news is bad news. And if the jobs report is really, really strong, that gives the Federal Reserve additional cover to raise interest rates a little more aggressively and get away from this bullish talk about the pivot, which will come probably much later. And of course, if the jobs report comes out quite negative, it's just the opposite. That'll give the Fed cover to lower the interest rate. So a bad jobs report, just in the way the market works, could be a bullish catalyst for stocks. Really, really good jobs report could be a bad, bearish catalyst for stocks. But we will not know until we cross that bridge in the morning session. What does the market say about potential movement in the report or in the aftermath of it? And what might our trading session on Friday be? To do that, let's first start with where we are on the big picture. So in the S&P 500, in the game, in the structure, we're still seeing the market go downtrend. Now these are swings, these are lows and highs, and the general trend of the market is down. So think about that as the fundamentals. The big picture is down. Does not mean the market is going to go straight down, nor will individual stocks go straight down. We're actually on this risk reversal or a counter trend bounce. Do not know how high it will go, but we're looking to these prior events. That's what these bounces are representing for potential targets, and one of the big ones is just about 3.8 or maybe a little bit higher on the current bounce. So that's going to be the first thing to talk about. In the NASDAQ, we see it, and that is our technology sector. That's a little weaker. So as interest rates go higher, technology stocks, that includes the ETF of the XLK, that's going to be a little bit weaker on some other sectors and some other equity futures products. The Dow Mini Futures, we're still watching that 29000 for the big support level, and its, call it counter trend or bear market rally, that's where we are now. And a key thing to look at in the future for short-term trades that last a little bit longer than a few sessions, and of course intraday trades, is to try to figure out, and this is the hard part of course, when the market will stop going up and will start going back down. That's where we are now. A little bit higher, but eventually the play will be a reversal back to lows, assuming the recession, assuming the inflation, assuming all the big headlines that are pushing stocks and pressuring them lower don't change. And for the Russell, that's about 1700. That's the big picture. What about the Friday picture? To do that, we can look at our expected moves. So if you look at the futures, we can do it individually, and of course on the ETFs or individual stocks you might have a position in. For the Russell, for the next trading session, the expected move, 35%, is pricing a move high or higher or lower, 35 index points. We'll go now to the NASDAQ. The NASDAQ is, this one, it's the 1 day expiration, 35% implied volatility, which says the NASDAQ could be up or down roughly 220 points by the close. And the S&P also has a 29 or above, almost 30% implied volatility for its expiration tomorrow, that has a 61 point expected move up or down. And in SPX terms, same. That's going to be 61. If we're looking at spiders, to position in spiders, something I like to do on the intraday basis in a little bit of swing, spiders are pricing in a $6.20 expected move. Could be bullish, could be bearish. That's just what the market volatility is suggesting about what the forecast and how the market could move and how we can position. Of course, if the market does move to those levels, that could be a fade or a short against. If it's an up move, it could be a long if it is a down move to those price levels. Just framing the game from a probability standpoint. Now, outside of the equity market, we are seeing a rally continue in crude. Now, that's not necessarily good or not necessarily bullish for the equity market, and some headlines in geopolitics and overseas developments are, of course, helping crude, or at least pushing crude a little bit higher. That's translating to higher gas prices at the pump. And that is, again, something we are all watching and all concerned about. Is inflation peaking and turning lower, or is inflation still here? And the Federal Reserve will have to continue their ongoing campaign with little reasons of stopping, of raising interest rates. And they don't control the 10-year or the 30-year bond interest rate, but they do influence the Fed overnight funds rate. So that does trickle up the economic chain. Nevertheless, the yield continues to have an uptrend and continues to aim for higher prices. And the only reason to stop that, one of the main reasons, would be the Fed saying, oh, we're sorry, we got it wrong. We've raised inflation too much, or raised the Fed funds rate too much. It doesn't seem like they're going to do that. And of course, we'll have their next meeting coming up. But the jobs report will be a window into how the Fed might think and interpret the strength or weakness of the economy as seen through the lens of employment. We can also take a look quickly at TYX, which is the 30-year bond rate, and that is pushing up to new highs. Outside of that, continuing to watch these inflationary trends is the dollar, which itself has a potential to go off and make new highs. Similar to other pullbacks, when the uptrend is in play, trying to figure out when the dollar will stop going down and hook back, turn back, trade back to the upside. And this just takes into the concept of a trend, or at least higher highs, higher lows, does have better odds to continue. Again, what could change this trajectory? If the big picture on inflation changes and the Fed backs away from interest rates, that hasn't changed yet, but that's, of course, something in the big picture that we are carefully watching. And we'll also take a look, just a quick reference before the jobs report, about gold. Gold futures are actually pushing back into a relatively lengthy multi-year sideways trading range. In simple terms, that's about 2,000 per ounce and about 1,700 on the lows. The market traded a little bit under that, but now prices coming back inside the range. And just to highlight that, that's a relatively long-term range that goes back to 2020, when that 1,700 was established as a support level and the 2,000 as a resistance level. This, of course, is big picture planning. And equity markets, just to make a comparison, had their rally and reversal, and the bullishness and the accommodative and supportive Fed, and now the inflation and the restrictive or money tightening or policy that is a little more on the raising rates, less free credit, less free flow of the money, and that is pushing or pulling the equity market down. And of course, the talk of recession continues to be on the forefront. Bond market is, again, we'll go back to the daily perspective. TLT is continuing the downtrend and is not far from new lows. So that is what we're monitoring in the grand scheme of things, the big picture. And of course, only one data point, but it will be a big data point. That's going to be the jobs report coming off tomorrow. So individual stocks, which ones made the biggest decline in today's session? American Tower. We'll kind of look at these quickly. American Tower, AMT. Southern Company, which also had a big sell side day. Triple M, which made new 52-week lows. NE, which is Next Era Energy. Duke, which is a utility, and that's the theme that's emerging at the end of the market and, of course, at the end of the video. Utilities, XLU, that's been a target for quite some time. We've had That's a line from 78 back to about 76 or 67, and that has been achieved in today's session. Takes the high back to the low. Utility stocks, the biggest decliners in today's session, but on the flip side of that, the biggest advancing sector is again energy. And that'll take the strongest stocks in terms of the movement in today's session of ExxonMobil, Chevron, and ConocoPhillips. Big jobs report tomorrow. There it is. Prepare for it and have a wonderful trading Friday. This is Corey Rosenblum with tonight's Theo video update for October 6th, 2022.